Growing your business can mean big-time logistical questions like, how are we going to keep up with all these local deliveries? Let Uber Direct offer you a helping hand. With Uber Direct, you take orders on your website, app, or by phone. Then drivers who are part of Uber's courier network pick them up from your store and deliver them to your customer's doorstep. Sounds simple, right? Delivery just got better with Uber Direct. Learn more at uberdirect.com. How can you tell if an emerging brand will be a long-term success? Hello, this is Jonathan Mays, Editor-in-Chief of Restaurant Business, and in this week's episode of A Deeper Dive, we are going to try and answer that question as best we can, if we can. It's not easy. A lot of private equity firms, restaurant executives, real estate companies, consultants, vendors, and others all work hard and spend millions and millions of dollars trying to answer that question. Thousands of entrepreneurs start new restaurants every year. Many of them yearn to grow those restaurants into major chains, but the vast majority of them, nearly all of them, fail to do so. This year has demonstrated just how hard it is to tell whether a brand will ultimately fulfill whatever promise it once had. Companies such as Mod Pizza, Uncle Julio's, Rubio's, Tijuana Flats, and many others, all of which had major backing at one point, either filed for bankruptcy or came close to it after their once promising futures did not come to fruition. And we recently told you the story of Baja Fresh, which 20 years ago was considered a pioneer of fast casual Mexican, only to quickly lose its place to the younger Chipotle Mexican grill, which has gone on to become Chipotle. Baja Fresh, meanwhile, has not quite done so. And so on the podcast this week, I have David Henkes, Senior Principal at Technomic, and the guy who gave me the idea about Baja Fresh in the first place to talk about this. Welcome to the podcast, David.
Thank you, Jonathan. Good to see you again. I appreciate you having me on.
All right, superb. Let's just talk about it from the get-go. How hard is it really to tell whether a chain is ultimately going to be a success or not?
Well, listen, I've been doing this 28 years now, and Technomic has been tracking chains. We were started in 1966, and I think our first chain list came out in 1970. So we've been doing this a long time, right, in terms of trying to look at success and project forward what it means. And I think it's really hard. And so, we've over time developed some commonalities that we see in successful chains. And so, and I'll run through those in a minute, but I think the point you're making, and I think it's true, is that it's very hard in the moment sometimes to actually look at a chain and figure out if they're going to be long-term successful. But when you look at the commonalities, I think there's two big things we look at, right? There's certainly execution, and that starts with strong unit economics. And so I think, that's probably one of the biggest indicators, not the only one, as we'll talk about certainly with Baja Fresh, but if the average unit volumes and the economics within the four walls of a typical restaurant are good, that's a definite sign. If it's got experienced industry leadership, that's a big part of it. I think the franchise strategy is huge, particularly in a lot of these emerging chains. Most of them are franchising as a growth strategy. And so looking at how deliberate they are and how much vetting they're doing with their franchises. Are they, just basically adding anyone that's interested, or are they actually being a little bit more selective? And then the other thing we look at is just how the chain is positioned. How much broad consumer appeal does it have in the menu category in which it operates? Does it have a defined menu category? Has it started from a regional point of excellence where it's already established some business and now it's growing, or is it, it's got to start from something. And a lot of times these chains that have grown into national powerhouses have started as very regional players that have grown into national players. And I think, today's day and age, it's got to be tech forward and probably have a little bit of off-premise focus as well. But, all of the things that go into that, you can check mark everything, and as we've seen, private equity can invest in it and kind of screw things up pretty quickly, right? And so, those are the commonalities. And I think a lot of times it's only in retrospect that we look back and say, hey, this chain had these things in common with other successful chains. But as you're standing here today, it is still really very difficult to project forward on who's going to be a winner and who's going to be a loser.
Mm-hmm. Yeah. And I mean, well, there's a lot there. You mentioned, I mean, like, for instance, you mentioned the franchising strategy. The franchising strategy is in a franchise situation. And, it's not always about whether if somebody is a franchise or not. But the franchise strategy is super, 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 super important. Like and I write about this all the time, about brands that we think today. And there are a number of them out there right now. I can tell you right now, they're growing today. And, but if you ask me in 3 years, whether, I could have seen a problem with it or not, I might say yes in some of these situations.
Yeah, and I think the franchise strategy is really a sort of a view into how the business runs, right? And I think that's really a microcosm and a really great indicator for how they view their business. And, are they just trying to grow for growth's sake, or are they really investing in those operators and taking a more deliberate approach? Because from that, you can infer a whole lot of other things about the chain in terms of, what their strategic priorities are.
Yeah. I will always put money on the brand that is growing at a more deliberative pace, versus something that is just putting a bunch of stores out there all at once. And it happens time and time again. I mean, if you look at, if you think about some of the chains, and you probably would agree with this, some of the franchise brands that are doing, the best right now, that you would say, all right, these guys know what they're doing. They have well established themselves, and they're absolutely going to go on to bigger, better things. Wingstop is a good example. Jersey Mike's is an excellent example of a company that really does this. But if you just can go on and on. Freddy's Frozen Custard is another one. Culver's is another one. I'm pretty sure you are familiar with that chain.
I'm familiar with, yes, I am.
And they all have very deliberate franchise approaches that are emphasize operations and emphasize franchisee profitability. And brands that fail to do that are just trying to get, and I think a lot of executives, and this is actually in and out of a franchise world, are so intent on getting that first mover advantage in the restaurant space. They might be growing a cookie concept, for instance, or they might be growing something else. When we saw it in frozen yogurt, we saw it in burgers, we saw it in a lot of situations where brands just furiously try to put a bunch of units out there to get first mover advantage, but they didn't really establish a system to support their franchisees, or they got bad franchisees, which don't, if you want your franchise to grow, don't just sell to anybody. The franchising strategy is easily in a franchise, probably.
Yeah. Well, and I think that's why the average unit volume figure is also important, because as you grow, if you are growing rapidly and you're not paying attention to the operational complexities and managing that, what you're going to see over the course of a couple of years is these huge growth numbers from an outlet perspective as they continue to add locations. And you're going to see a corresponding decline in average unit volumes, because as they add more locations, they're either cannibalizing or they're just not paying attention to the stores that already exist. And so that, in my mind, is one of the great metrics. And, and again, it's never perfect, but if you're seeing a chain grow at a pretty good pace and their AUVs are keeping up with or growing and continuing to maintain or grow, I think that's a really good sign that they've got a good handle on the operations and they're focusing on those existing businesses, right? Because we've seen too many times they grow and, suddenly they've got 500 locations, but those first 50 were, already not doing great. And that was a yellow flag for perhaps for a lot of franchisees that ignored the yellow flags. And so I really do think you have to look at those average unit volumes as a big indicator for how healthy a chain is at a particular time.
Yeah. Yeah. I mean, but it's not just, see, the interesting thing, and eventually we're going to get the Baja Fresh, because that is a really, really good example of how things work. But, is it's not really just, franchise brands that make that fast growth mistake. Mod Pizza is actually, I mean, they were, I'd say, now they do a lot of franchises, but a lot, I think more than half of their locations are company owned, and they had a lot of money. They had a couple $100 million. They had a lot of money to expand, and were furiously trying to open as many locations as they could. And this is, I think, where your unit volumes story really matters, because their unit volumes weren't growing, and they were adding all of these units. And I think that desperation to grow, and this is where private equity can really damage a growing brand, because they push extreme growth in a short period of time. These private equity companies were investing, and this happened a decade ago, they were investing in all these fast casual brands, these up and coming names that they felt were going to be the next big thing. They were all looking for the next Chipotle. And what they would do is put all this money behind these brands, and then these companies would just furiously try to open units, and they ended up compromising either their real estate demands. They would pick, substandard locations. It happened a lot in Mod's case, or they signed leases that were too expensive, that would cause them problems down the line. Fast growth is not just a franchising problem, which is one of the big lessons from this year.
And it's interesting you mentioned Mod, because I look back at a presentation we did a couple years ago, and and Mod was one of those where at the time we were looking at it, right? I mean, back in 2011, they were number 1,255 on our chain restaurant list, right? So they were, just small. And by 2021, they had grown into the 78th largest chain. And so that growth rate, calculated it was something like 20,000%. I mean, it was like a ridiculous number over the course, not an annual growth, but obviously the sales that they achieved over that time was tremendous. But to your point, they were growing beyond perhaps what the market was willing to bear for them. Mm-hmm. And I think that's, the other thing then, when you look at sort of consumer demand, consumer appeal, that it brings another piece of it in is, fast casual pizza has a very specific day part, a very specific occasion. And so you have to look at how people are using that and what the consumer appeal is. And does the market support this rapid expansion given where its niches or where its focus is? And I think that's an example where perhaps, now they're still, I think, number 80 on our list. So it's not like they've completely fallen off. I mean, they're still there. But certainly fast casual pizza as a segment is well past its growth phase, that we would have seen 10 years ago. Right. And probably largely because pizza has sort of fallen off, but not fallen off, but just from a growth perspective. But two, fast casual pizza is a very specific occasion that people use it for.
Mm-hmm. Yeah. And that occasion is not quite there like it used to be. I mean, fast casual pizza is one of those areas I will acknowledge that was one area I was really wrong. And I was really wrong about Mod Pizza. I thought that was, that they ultimately had some legs. I mean, I think the pandemic created some real issues with that sector. And it just doesn't really have but we look back at it now, the consumer demand wasn't quite there the way a lot of us thought there would be, several years ago. But if you look at their unit economics, and this goes back to your unit economics comment, their unit economics were not growing as they were adding units. And that's a big, big red flag to me. If you can't generate consistent growth in unit economics, and again, or in unit volumes, you have to be able to support demand for new locations. And if to me, if you're adding a bunch of stores, but your sales remain flat, you have no business opening new stores, because you don't have the demand that you think you do to fit more locations. And
you're not growing the demand.
Mistakes. Yeah. Mm-hmm.
Well, and, I think we're in a weird situation too right now. I mean, it's late 2024, but we're still feeling the effects of the pandemic. And so I think there's, for the next couple of years, for sure, there's still going to be some things that we look back at 2019 and say, this should have worked. But the pandemic, for a number of reasons, screwed things up, right? And I think, fast casual pizza is one where it was primarily, the day parts got disrupted to such a great degree. Everything shifted to delivery. Fast casual pizza is not set up for delivery as much as it is for dine-in or for people going in. And so, absent the pandemic, would fast casual pizza be in a different place? You could argue maybe it would be. I mean, I guess, as you note, the volumes weren't growing per location, but there are some chains and operators and segments that are still dealing with the aftermath of COVID. And so we're in a sort of a strange situation where we're trying to judge winners and losers, but a lot of them made business decisions during the pandemic that maybe weren't the correct ones, or that they just were impacted, that, is still, they're still dealing with today.
Yeah. Yeah. So one other thing you mentioned was private equity. And one conclusion that I have from this whole year is private equity is certainly not the only one that destroys growth restaurant chains. Which brings us to Baja Fresh. And this is, and I like to give you credit on this one, even though I run with this entire thing, because, we've been traveling the globe together, and you've presented this a couple of times during that point in answering this question. And is that comparison between Chipotle and Baja Fresh, which I didn't actually realize until you pointed it out. But in 2002, Chipotle, Baja Fresh had stronger unit economics and more total sales than Chipotle did. They had, I think Baja Fresh's unit, I think their average unit volumes were 1.5 million versus like 1 million for Chipotle.
Yeah, 1.1, and but they were, and one of the reasons I pulled this example out, and it's a presentation I gave a year or two back, but I thought it was interesting because as we talk about identifying winners and losers, if you and I were talking back in 2001 or 2002, right, and we looked at Chipotle and Baja Fresh, you'd say they're almost identical. I mean, their sales were both between $225 and $250 million. They both had slightly over 200 locations. Their average unit volumes were pretty similar. Again, Baja Fresh was a little bit better than Chipotle, but there was no inkling at the time that Chipotle would have grown into this huge powerhouse chain that it is today, and Baja Fresh would be just a shell of what it was even back in 2002. And so I think, that's one of the learnings that I took from that, is that in the moment, you can look at two chains and pick one, but some of the subsequent events that happen can also damage the brand. And I think, that's what your research has found out as you've dug into the Wendy's acquisition and what happened there. But it is sometimes hard because what makes a chain attractive, and maybe, in an alternate universe where Wendy's didn't buy Baja Fresh, or they treated it differently when they did buy it, you can make the argument that maybe it is Chipotle-like now, but it's not. And, and that's because of sort of the subsequent things that happened after that data was developed that I pulled in, about 2002.
Yeah. Well, the thing is, because when I saw the data, and of course, David, that just really I'm like, oh, wow, really? And I went, and the first thing that I did was I went and looked what happened in 2002. Because if you look at the numbers, it was literally after 2002, those two chains went on a complete divergence. Baja Fresh is a fraction of its size that it was. Well, not a fraction. It's about a fifth of its size that it was that year. Their unit volumes have fallen by 60% over that particular period. I mean, meanwhile, Chipotle has gone on to become a top 10 U.S. restaurant chain. I mean, the divergence is wild. And what happened in 2002 is that's when Wendy's bought the concept. Now, I guess one thing I will say, first off, I don't think it's all Wendy's that did this. It wasn't really Wendy's. Okay. So, I mean, I think that Wendy's made some clear mistakes. And I spent some time talking with Greg Dollarhide, who was the CEO at the time, and he talked my ear off. It was a great conversation. And I came away with a few things from it. Number one is that part of it is Chipotle was really, really set up very, very well. First off, Baja Fresh was started 3 years before Chipotle was. Baja Fresh probably has every single right to the claim of a fast casual pioneer that Chipotle does. Chipotle was not the first one of those burrito chains. This is another thing. Getting first mover is one of the more overrated advantages, I think, in this scenario. The big thing is, and one thing you would like to think of, well, Chipotle had McDonald's money behind it. But how many other chains, you remember in the 90s, how many other chains had McDonald's money behind it? Boston Market, they're not doing anything. Fazoli's, they're not doing anything. So most of the chains that they invested in really haven't gone on to become sort of Chipotle. But one thing that they did was they left Chipotle to do Chipotle stuff. And then really, they tried to change it. But, Steve Ells could have said no on a number of things. And he often did. But they taught them, one of the biggest lessons, I think, that McDonald's taught Chipotle was about real estate. And that's one of the more underrated elements. And we talked about it already. The real estate strategy is so important in a restaurant, in restaurant decision making. And it really kind of goes back to some of the franchising thing that we talked about before. Where you're putting locations is just absolutely vital. And Greg told me a story about, like, he went to ICSC, the International Council of Shopping Centers conference that we never go to because it's during the show. And he went with a couple of people, to look for, talk to real estate folks, as you tend to do at that particular event. And when he went there, they went to the restaurant section, and Chipotle sent like 30 people all wearing brown shirts and were dominant and had a massive display at the time. Portraying themselves as the next big thing. And this was right at the same time. Baja Fresh was bigger than Chipotle at the time. And Chipotle had this massive thing. And it was, it was one of the first stories Greg told me. And he basically said, McDonald's taught them about real estate. And that was such a key element for Chipotle. And it helped. It's one of the big reasons why Chipotle is Chipotle. They know today how to get really good real estate. So that's one of the things. Chipotle was just such a tough competitor, even at the time. And again, you can't tell. If we looked at the numbers, I'll tell you, if those numbers that you showed from 2002, the unit volumes, I would have bet on Baja Fresh all day long. So the real estate is the one element. And then the other thing, and this is probably a big one where you could talk about, Wendy's didn't put any more money behind Baja Fresh. They bought Baja Fresh and basically expected Baja Fresh to sort of live on its own. And I don't think that's where I think where Wendy's probably made the biggest mistake, because growth chains, David, need a lot of support, and it takes them a while to be able to stand on their own.
Well, and that's one of the reasons I think, I'm a little concerned when I see big chains buy up smaller chains like that, because for the most part, the smaller chains are rounding errors for the big chains, right? Mm-hmm. And so what is their actual incentive to help grow the business, right? I mean, they've got, 2,000, 3,000, 8,000, whatever, number of locations of their own brand that they're trying to build and grow and nurture. And suddenly you bring this upstart in with, 200 locations, 100 locations. How do they support that, right? And how do you divide management time to do both? And so, what Wendy's did, I think, is perfectly natural from a large chain perspective. We bought it. Now let's let it go on its own, and hopefully it grows. But the big chains, generally speaking, I think, aren't going to put that type of nurturing. And, and again, McDonald's bought all of these and they ended up spinning them off too, because I think they realize that they can't grow this behemoth McDonald's and do what they need to do while splitting time with Chipotle or splitting time with Boston Market. I mean, and so I think it's a lesson there that, and to your point, that it's not just private equity that sometimes screws things up. I think big chains don't always know how to nurture small chains, and they run into challenges with that because they're too busy trying to kind of nurture their core brand, and all of these other things kind of go by the wayside.
Mm-hmm. Yeah. Plus the other thing, and I think that it's easy to forget, is the cultural issue. It takes so long. Big companies take a while. It takes a long time to get stuff done when you're a big company. Sometimes smaller chains have to respond quickly to events and stuff like that. There's a massive cultural difference between a big concept, a big established chain, and a growth concept. That can be really shocking, I think, for the smaller brand. And I think what McDonald's ended up doing is Chipotle was sort of its own. It wasn't really sort of folded into the McDonald's system so much as it really was its own brand, and own concept. I mean, they did test stuff at the urging of McDonald's and things of that nature, such as franchising. They did actually test franchising for a while. But they were, and McDonald's pumped more than $300 million into Chipotle in the time that it had owned it. That's a significant level of investment into the concept, and it enabled Chipotle really to get on its own feet. And then by 2006, of course, Chipotle had one of the best, arguably the single best IPO the restaurant industry has ever seen, especially if you look at it on a long-term basis. And that same year, Wendy's sold Baja Fresh at an 89% reduction in value. Pretty big contrast.
Yeah. Well, and one other thing that I think, to your culture point is just, and it's one of the things I mentioned early on in terms of what we sometimes look at is the leadership, right? And the culture starts at the top with leadership. And, what you saw, with Baja Fresh is some, fairly rapid turnover after the Wendy's acquisition, right? I think Greg lasted, another year or two after Wendy's bought, and Steve Ells did not, right? And so, and I think having that leadership and building the culture and not having rapid turnover, which often happens in acquisitions, that's sometimes an underappreciated part of that acquisition process, is keeping the team in place, or keeping, that figurehead or the founder or whatever, and somehow keeping them involved. I think really pays dividends down the road, because that's still the sort of the spiritual leader, if you will, of the brand, certainly for Chipotle. And, I think, the fact that he stuck around really also helped Chipotle, and, conversely didn't help Baja Fresh, that they're suddenly, they had a whole bunch of leadership turnover after Wendy's bought them.
Yeah. Yeah. I think that is a very significant issue. I completely agree with you. I mean, they ended up having like 3 different CEOs during Wendy's ownership in 4 years, less than 4 years. And that was just bad. You can't, even if Greg was planning to leave, they could have done some sort of succession strategy, where they are able to maintain the culture and maintain sort of the strategy behind it. Instead, they hired a Wendy's person to be the CEO. Again, nothing necessary. I'm sure, it wasn't necessarily bad per se on the surface, but, making dramatic cultural changes like that. And, you bring in a CEO, especially if that CEO comes from outside, that CEOs always want to do their own thing. New CEOs always want to have their policies in place. And the result is sometimes things at work are eliminated because the new guy, or woman wants to do something different, wants to put their own mark on the chain. And then ultimately things end up going awry, and then it just new CEOs, it can be tough on a concept. And I think sometimes the CEOs change a little bit too quickly. in my book. And that's definitely one of them. No, super. David, this was fantastic. Really appreciate you joining me this week on the podcast.
Yeah, thanks for having me. Always appreciate coming on, and hope to see you here sometime soon in person.
Yeah. And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening. Growing your business can mean big-time logistical questions like, how are we going to keep up with all these local deliveries? Let Uber Direct offer you a helping hand. With Uber Direct, you take orders on your website, app, or by phone. Then drivers who are part of Uber's courier network pick them up from your store and deliver them to your customer's doorstep. Sounds simple, right? Delivery just got better with Uber Direct. Learn more at uberdirect.com.